You can try a lot of things to build passive income in Germany. Side hustles, Airbnb, rental properties, maybe even try dropshipping and Amazon FBA. But from my own experience, dividends are by far the simplest way to start replacing your income. Now imagine if you buy one share of a company and every single year they send you 5 kilos of chocolate as a thank you. Sounds like a scam, right? Well, it's not. Lindt chocolates actually do that. But unfortunately, that one share costs well over 100,000 euros. That's why it's important to understand how dividends actually work. So in this video, we're going to discuss exactly how much money you need to live entirely off dividends in Germany, whether you should focus on dividend stocks or dividend ETFs, and the real pros and cons of dividend investing. By the way, if you're new here, my name is Essen, and on this channel, we discuss how to build wealth in Germany. So how much do you need to live off dividends in Germany? Let's say you want to live entirely from dividends in Germany. You can calculate the total amount in 3 steps. Step 1. Know your target annual income. It all depends on your expenses. If you live in a big city like Munich or Stuttgart with higher rents per square meter, your monthly costs will be very different from someone living in a cheaper city like Chemnitz. To keep it simple, let's use a round number, 50,000 euros net per year as a lifestyle target. That's about 4,166 euros per month. Now, of course, everyone's number is different. Maybe you're happy with 2,000 euros per month, or maybe you need 6,000 plus. But we need a number to calculate. Step 2. Pick a realistic dividend yield. Serious high-quality dividend payers, the so-called dividend aristocrats having 25 plus years of increasing dividends, usually have yields of around 2 to 4%, sometimes even up to 5%. Let's assume an average of 4% yield on a diversified dividend portfolio. Step 3. Do the calculations. To get 50,000 euros per year at a 4% yield, you need 50,000 divided by 0.04. So, to get roughly 4,166 euros per month, you would need about 1.25 million euro invested at 4% yield. What about 1,000 euros per month? That's 12,000 divided by 0.04, which is 30,000 euros. Yes, these are big numbers, and most beginners think that's impossible. But dividend investing is not a quick game. It's a multi-year, often multi-decade journey. You might start with 5,000 euro, then keep adding 200 to 500 per month, reinvesting dividends, letting companies grow and increase their payouts. Over 10, 20, 30 years, those numbers become more realistic. But like everything in investing, there are downsides too, like taxes, among many other things. So before we get into the dream of living entirely off dividends in Germany, we need to understand a couple of things. Companies do not owe you a dividend. If times get tough, they can reduce or stop it completely. You might have already seen this in big names. Some companies had yields 4 to 5% a few years ago, and now they are down to 1 to 2%. Others like Disney stopped paying dividends completely during COVID for a while and only resumed later on. So if your entire passive income plan depends on 1 or 2 companies always paying and increasing their dividends, that's very risky. In Germany, dividends are also taxable the moment you receive them. You pay about 25% capital gains tax plus solidarity surcharge plus church tax if applicable. So in practice, that's usually between 26 to 28%. And if dividends come from a foreign company, there's often additional withholding tax in the source country, commonly 10 to 15%. Some of that can often be credited back via double taxation agreement, but it's paperwork and not always one-to-one recoverable. For small portfolios, this tax can still be okay because you have a tax-free allowance of 1,000 euro per person and 2,000 euro as a couple per year. So as long as your dividends plus interest plus realized gains stay below that, no tax is due. But you still need to set up your Freistellungsauftrag with your broker. Otherwise, tax is withheld and you only get it back with your tax return. another downside of dividend investing is that high dividend does not protect you from price crashes. Let's say you get a dividend yield of 10%, but your stock price drops by 50%. You still lost a lot of money overall. That's exactly what happens with many high dividend problem stocks. The business runs into a trouble, the share price falls hard. The dividend yield looks massive on paper because the price is so low. And people think, wow, 10% yield. And then the company cuts the dividend and you're left with both price loss and lower income. A German example is Bayer AG that struggled with lawsuits and big restructuring. The share price fell, the yield suddenly looked crazy high, but the underlying business was still in trouble. That's why dividend yield alone is a terrible indicator for quality. But why do so many people still like dividend investing? One of the biggest reasons is the price stability. Stock prices can move like crazy, but dividend payments are often less volatile. Many companies actually try hard not to cut their dividends. Instead, they hold it stable in bad years and even raise it slowly in good years. That's especially true for big established companies, sectors like consumer staples, healthcare, and utilities. We now even see tech giants like Meta and Alphabet starting to pay dividends. So when companies that used to reinvest everything start sharing profits, that's often a sign of maturity and stability. There's also a psychological aspect. Imagine the market falls 20%, but in the same week, you see €200 dividend received, €35 dividend received. These dividend payments can reduce the stress and panic. That psychological effect is huge. It doesn't show up in the numbers, but it helps you stay invested, and that's the biggest success factor in long-term investing. And historically speaking, a very big part of total stock market returns comes from dividends plus reinvesting them. So when prices go up, dividends add extra return. When prices move sideways, dividends are often the main source of return. And when prices go down, dividends cushion the pain a little bit. Now, dividend stocks overall have done about as well as the broad market, sometimes slightly better, sometimes slightly worse, but with a different feeling for investors because of the cash flow. What about dividend ETFs? It's a good question. Because of diversification, dividend ETFs usually have lower yields than the highest paying individual stocks, but they're also less risky. Imagine an ETF has 100 dividend stocks. Some pay 2, some pay 3, some 5%. The average might be around 2 to 3%, hence the overall lower yield. SCHD and SPYD are some of the most popular dividend ETFs. But unfortunately, in Europe and Germany, you cannot directly invest in SCHD. However, VGWD can be a good alternative if you are looking for a worldwide coverage, or FUSD, which is quite similar to SCHD. German dividend ETFs, like those tracking the DivDAX, which includes large German dividend pairs like Mercedes-Benz, BASF, Deutsche Bank, Volkswagen, etc., can be a good option. And historically speaking, DivDAX yields around 3 to 4% and moderate growth over time. With dividend ETFs, you get automatic diversification and lower company-specific risk, but you still get regular payouts and often more tax efficient thanks to ETF rules in Germany. However, you do get lower yield than picking the very best individual stocks, and you own some mediocre companies along with the great ones. And at the end of the day, you still need a decent amount invested to get meaningful monthly income. But if you are still unsure about dividend stocks versus dividend ETFs, dividend stocks are good if you enjoy researching companies and accept higher company risk. You want to own your own dividend heroes and you're okay with volatility and potential cuts. On the other hand, dividend ETFs are good if you want diversification without picking single stocks and prefer a simpler, more passive approach, but are okay with slightly lower yields. So, can you live off dividends? Yes, you can live off dividends in Germany, but it takes time, discipline, and a lot of capital, usually several €100,000 or more. Because dividends are not magic nor guaranteed free money. They are a simple starting point for passive income and a great psychological help to stay invested during market crashes. If you want to see my full portfolio and want to know why I reduced my number of dividend stocks, you can check out this video. And if you're interested in what I do with every paycheck, you can watch this video.